everyone, and welcome to this little 30-minute talk on why business people and also professionals should be looking at investing in other people's companies and not just in their own. Okay, so why you came here today? Obviously, you all came here to see a PowerPoint. That's what people want. I promise it is not going to be the usual dull, boring PowerPoint. I'm going to give you lots of valuable, insightful things, and I will make it more interesting. However, it will be useful to show you some slides because it's the best way to convey a lot of information in a short space of time. Now, my background is I'm a hedge fund manager, so I'm a specialist in investing, but I'm not giving individual investment advice, obviously. I have to say this and let you know because I don't know your individual circumstances. So this is more generic advice on why, as I said, whether you are a young professional or a business owner, you should be investing yourself. And I'm not representing a brokerage or a fund management house or anything like that. So there's no conflict of interest with you whatsoever. And let's see if this is a bit stronger. Is that a bit stronger? I'm going to try this because my voice is not as strong as it used to be. I've got a 3.5-year-old son and he's pretty much stolen my vocal cords. Now, I'm going to break this into two parts. First of all, why aren't people making the most out of investing and the kind of returns that they can get from other companies? And secondly, well, what are some of the things that funds like mine like, Goldman Sachs like, that Warren Buffett likes? Those things, whether you are, as I said, whether you're somebody in their 30s or 20s who's looking at just starting out and has only got, say, £5,000, or whether you're somebody who's got their own business and has got millions sitting in the bank account, there seems to be a lot of dormant cash, either already in your account or you plan to have it because you plan to grow, which is why you're here. So we need to plan ahead and work out what you should be doing. Feel free, by the way, later on to take pictures of any slides. Do connect with me if you wish. That's just me showing off about my background, and that's why I thought, so you don't think I'm totally arrogant and unapproachable, I'd do a picture of my alter ego, Apu, just to make it a bit more realistic of what I'm really like. So as I said, my background as a hedge fund manager, I've also written about investing. And that's the insights I'm going to share with you, both as a practitioner and as somebody who's written about it. And I've written about it, including in the FT, for about the last 20-odd years. So there's a lot of experience to share with you and also from my programs. And that's what I want to get across. And I said I've got no conflict with you because we don't deal with retail clients. It's that simple. But I want retail clients to know what we know about investing. Because a lot more regular people, whether they're professionals or business owners, leave it too often and pay fat fees to fund managers, or at least don't even know what questions to ask them, or they spend their lives working incredibly hard in their businesses or in their professions, and they don't have their money working hard for them. So they bust a gut making 100K a year or 50K a year, or I don't know, maybe even be bust a gut making $1 million a year. But the money just sits there. Whereas that money could be earning more than you're doing in your salary, and that's the point of it. Okay? So let's focus on what I'm going to be talking about in particular, which is, well, how do I get my money working harder for me if I don't know where to invest and how to invest? And I'm going to focus on the public markets. Why? Well, because at the click of a keyboard button, you can exit. But we need to know, well, how do I pick stocks? That's just the last 6 months. It might be a bit difficult to see. Not everything's done well. Some people have been banging their heads because they've picked the wrong thing when the market hits an all-time high. Others have banged their heads because they didn't do anything about it at all at any point. And those are the problems we're going to try and resolve. How do you know what to do, where to put that capital, and be absolutely independent about it and say, well, actually, you don't have to go to a particular fund manager or a particular broker or a particular IFA. You should at least have some knowledge of that, because if, like I said, you've spent your life earning that money, that passive income should be earning a dual income. You're basically cloning yourself. That's the point of it. And the way I want you to look at it is this. Whether, like I said, it's 5,000 you've got or 5 million, when you invest in a public company, so we're not talking private companies, we're not talking about the risk of your money being locked up, we're talking about public companies, the names you've heard of. I want you to think of it like this. It's like hiring somebody in your business. If you're hiring somebody in your business, you want to look at about 10,000 CVs, I would have thought. You want to look at as many CVs as possible. Because when you invest in a company, a listed company, a public company, you're asking them to manage your money to make you a return. Either because you're in your 30s or 20s, you want to get richer when you're older, or you're retired and you want that money to give you a comfortable retirement. They are basically managing your capital. If they're managing your capital, they better be the bloody best of the best in the world. How do you make sure they're the best of the best? Well, you look at a lot of CVs. In other words, you look at a lot of companies. But that sounds complicated. That sounds like you're going to spend the rest of your life doing that. So we need to find a simpler way of doing it. And thankfully, there's so many free tools on the internet to be able to do that. But first of all, you need to know, well, how do I do that? Where do I begin? And like I said, it might not be that you've got the capital today. It's the fact that you will have the capital. And the reason this has become incredibly urgent is because my fellow British pensioners and also company owners and business owners and professionals are getting poorer whilst the overseas ones are not, for a very simple reason. When you've got a job and you're putting money into a pension, most people don't even realize that goes into a fund which invests in the stock market. Or if they know that, they don't realize that they could ask questions. Where the heck is that going? And most fund managers will invest in the domestic market. Nothing bad about that. I'm British. I'm delighted they're investing in the domestic market. The problem is, since 1999, the 100 largest British companies have increased their value by 0%. So chances are your pension stinks compared to if you happen to be American. Now, governments of both colors, Conservative, Labour, want pensioners to be rich, believe it or not. Politics aside, they do. So they don't mind if you invest in non-British companies, in global companies. And that's the first thing. We're going to look at those 10 CVs, not just from a narrow gene pool of UK-only companies, but from a global gene pool. So when you invest in an American company, let's say, or a Chinese one or whatever, and we'll narrow it down what you might want to look at least you have the security, you can click a button and be exited. But more importantly, they're earning, and you're bringing that return back to the UK and spending it in Britain anyway. So it's good for your pension, it's good for the country, okay? So why don't people do it? First of all, I'm going to give you 2 reasons why people don't do it, and then we'll talk about the meat of the problem, which is, okay, well, how do you go about it? What should you be asking your IFA? What do you do about a SIP doing it yourself? What are the questions to ask, and how do you do it? Okay, well, the first problem is really this. That sums it up. It's fear that you're going to get it wrong and the market's going to come crashing on you. Well, I'm afraid you're already invested, and if you're not, then that money's going down because of inflation. Or it's overconfidence. You think, you know what, I've got the best business in the world, it's going to make me all the money I ever need. I don't need to invest in other people's companies, a Microsoft or a PayPal or a Oracle. I don't need to invest in those companies. Yeah, I hear Apple hire a lot of clever people, but no, my business is going to do better than theirs. That's fine. I'm not saying don't do your business. I'm saying when you've not even diversified by investing a bit of your pension elsewhere, we've got an issue. Okay, we've got a problem. The other reason you don't do it is you might look at CVs of people like me or people in the industry and you think, they walk around a bit cocky. I don't really want to ask them. I don't want to ask them because they might think that, what the heck, you don't even know what to do? You know, there is that feeling that, oh, I don't really want to deal with investing. Those are people who I don't really want to even speak to. There are people I don't even want to speak to. Follow me, feel free. Follow me on LinkedIn. We're not as bad and unapproachable as you might think. So there's that fear of knowledge. So we're going to remove that fear. We're going to show you a bit of what you need to know. The other main problem you need to do this, and it's urgent, is this. Like I said, if you're in a job, how many of you have got a job as opposed to being self-employed? Just put your hands up. A few of you. And how many are self-employed? A lot more self-employed. Now again, I'm self-employed because I run my own company. Thank God I did set aside extra capital, which had nothing to do with the business, but had to do with investing in other businesses through a SIP. Whichever you are, whether you're self-employed or whether you're in your own company, giving it to a fund manager has problems. I'm not saying you shouldn't at all. One of the biggest problems is they're charging you fees so that little Johnny and little Jane can go to private school, and you're being stiffed by those investments being in an index which goes nowhere for 20 years. Where are your yachts and private jets? That's the basic problem, which is why, again, I want to show you what you need to know. And it's even better if you're in your 20s because you've got more time to apply it. And that's the sort of pension gap. It's difficult for you to see at the back, but let me show you what that is. That's the difference between if you were just even tracking a broad index of listed stocks and you followed the UK over the last 5 years, and it's the same over any rolling 5-year period since the Second World War. You've got pretty much 0% from what your fund manager's doing, and you've doubled your money by having a broader gene pool of global companies, including some of the big American ones. You might say, oh, that's just for now, Alpesh. No, it's been the case for a long period of time. And you can invest in those directly. And if you're not confident, then at least you can ask the fund manager or the pension provider, hey, mate, what have you invested in? And the biggest problem that people have is they don't even know. So they look at things like this, and this is literally a screenshot of a typical fund, and they'll say, and it'll have words like A, or 5 diamonds, or a score out of 10, and they'll say, oh, this must be good, and it's got the word growth in it. So I'm okay, because my pension fund, or my SIP, or my ISA is in something with the word growth, and it's got lots of diamonds, darling. We're safe, our future's taken care of. No, the fund manager's future's taken care of, not yours, for a very simple reason. If you ask them to show you how they've performed, and they have to by law tell you, you'll invariably see that over any period of 3 to 5 years, after the fees they've charged you, they've delivered you next to nothing. Other than a few random, and it's been proven, random fund managers who do well for a very short period of time. And you know why they do poorly? And the mistakes you're going to avoid? Because they spray and pray. They will invest in as many companies as they can think of. Think about it, they're marketing outfits. Fund managers, your pension goes to a marketing outfit. That's why when you go down the road and you see M&G, Fidelity, and all of this, they're advertising so they can get as much money as possible under management. Why? Because they charge fees of a percentage of assets under management. So they need to get as much under management. But if they've got lots of money under management, they've got to divide it into small gene pools of UK growth. So they do geography and style, UK growth, Japanese income, American growth. And each one of those funds will have all those trillions divided into sublots of maybe 50 stocks at a time. So if you put your money in just 5 funds, that's 5 funds, 50 stocks, that's 250 stocks. So you look down and you go, oh, it's okay, I've got a bit of Amazon and Apple and Oracle. Well, you've got 1/250th of your capital in those. No wonder it's not performing, let alone the fees they're charging. You can ask them all of this. The first thing I want you to do is to be aware of it. Please, for God's sake, be aware of it. Okay? And if you want to see when they call themselves growth what they invest in, because you can ask them that as well. So this manager, and I picked him at random, and I guarantee if any of you've got pensions through SIPs, and like I said, most people don't realize pensions are invested in the stock market, this is a growth one, and he invested, this genius, in British American tobacco. Tobacco. Who thinks tobacco's a growth area? Without knowing anything about stocks. And he invested in oil before oil prices last year went to 0, let alone what's happened now, before they went to 0. Anyway, enough of the stock pit. I'll tell you what stocks I like. Now, you might say, well, Alpesh, you're talking a big game. Got a big mouth saying that regular people can be better than fund managers. Well, no, I think they can learn a bit more, so they're more in control. So the FT said the same thing to me in 2004. They said, well, you say you can be good. How do I know you can? So they ran a competition over 12 months. And at that time, I didn't have a hedge fund, didn't have any of that, which is a regular bloke like you guys. And they ran a competition with other fund managers. And I said to the FT, well, when I beat them all, will you please put my face on the front page of your business section? And when I did beat them all, regular retail guy like you guys, so it can be learnt, okay, they did do that. And you know who came 17th? One above the editor's cat. They literally had the editor's cat there to see if the editor's cat could beat fund managers. The editor's cat picked levels of stocks to pick based on random numbers. Okay? The editor's cat nearly beat Neil Woodford, who gets paid billions, or did, before everybody else discovered that is rubbish. It's the truth. So you might think, well, how the hell did they get away with that? Marketing. You don't think fund managers with those CVs that make them seem unapproachable don't do marketing? That's marketing. That's why I want you to be aware. And it's not a new thing I'm saying. I've been saying it in my FT columns for 20 years. The other problem you've got is this. For every £10,000 you work incredibly hard earning, or your business, you take out of your business, you pay all your taxes, your PAYEs and your NIs, everything else, you're left with that 10K, £1,000, 10% of it goes into fees over every 5 years to the fund manager. Now, if you could do more of that yourself, you get to save that alone. Just that, okay? But I know you're probably thinking, hang on, Alpesh, I'm going to have to become one of these guys. If I'm going to look at the stock market, I'm going to have to be junkied up on caffeine. It looks like it's too complicated, so let me try and simplify it. Just as a starting block, just for now, make sure we're all right for time, Okay, so how do regular people, and look, we had a great tailwind over the last 12 months, regular people, not giving it to fund managers, not paying subscriptions or fees to anybody else to do it, you doing it, get returns which get 50%. That happened last year. That was an exception. It's not me doing it, it's you doing it, but only because there was a tailwind. There might be a headwind next year. My point is, there's a lot there happening amongst people doing it themselves and getting those returns and those missing out. So how do we make sure we don't miss out? And these were some of the ones which I'm going to show you an approach I want you to look at yourself and investigate it in your own time after this, where you find the data free on the internet. Thankfully, it's all free, and I want to make sure everything's free that I tell you. That looks at the value of a company, i.e. its profitability, it's growing, its sales are growing. All the things you know are important in your own business. How about using that know-how you already know as business owners to put a tiny bit of your pension into those other companies which are listed so you can get the hell out of there if you need to at any point for the sake of your pension. And when I say Crocs, I didn't know it was going to be up 200% in a year. You know, Crocs, who make those ugly footwear. Guess what? Cash flow was strong, profits were strong, revenue was strong. I wish my business had the figures that ugly shoe-wear company did. Seriously, 200%? Whose business grew 200% in the last year? Yeah, yours did, but that's because we know each other. Air for Life. Go have a look at their stand later on. And that, I know it grew 200% because it's a phenomenal company. But on the whole, you're looking at public companies to try and do that. So how do we find some of those? Let's narrow down. And this is a list. You won't be able to see it, but it's on my LinkedIn page. I'm going to put more of the stuff there, so it's all be free and it'll be on there. That's last year. I'm not saying buy these this year. That's over the last year. Now, the fact of the matter is, it is impossible to know what's going to go up 100%. And 100% has a lot of good fortune in it. If the markets don't rally next year, that ain't going to happen. Okay, and if you want certainty, a bank account is the best place to get it, maybe at Starling Bank, right, if you want certainty. What happens is you want to narrow the pool you're picking from so you remove all the bad companies. I don't like waking up at 3 in the morning and thinking, why did I give my money to that company whose sales are dropping, profit margins are being squeezed, and its price keeps going lower and lower? Who wants to work hard for a living? I don't want to do that. I want the companies which keep growing sales, who have the cleverest people in the world employed by them to do it. It's a hell of a lot easier riding those coattails than it is trying to turn around and speculate, and I don't like speculating, and gamble on companies which, oh, hopefully the government might do a tweet on coronavirus and this company might turn around. Or look at that company, it's crashed and burned. Let's put our life savings in that because it might turn around. No, don't be stupid. We want to look at the valuation, the revenue growth, the things you look at in your own business, cash flow growth. Those are going to be the 3 most important. Well, those things still apply to public companies. Exact same rules, same thing. You already know the essence of how to get those returns. And there was a whole bunch which did 50 to 100. Did I know ahead of time they were going to? No, I don't have a crystal ball. The point is, anybody who's honest about the market will tell you the job is to try and remove the rubbish, and then hopefully what you're left with will give you an increased probability that if there is a tailwind, you get a market outperforming return, and if there isn't, and I don't know if there's going to be a crash next year or not, despite all the big talk about FT and my books and columns and all the rest of it, I don't have a crystal ball to tell you that. And you know how I know I don't have a crystal ball? Because I didn't see coronavirus. I didn't see the financial crisis. And anybody who tells you they did, they're lying. Or they're lucky. Or they're stupid. It's going to be one of those three. So let's be honest. My job is to remove the rubbish companies, which you can do easily enough. And hopefully what you're left with is some of the good ones. And if you don't want to do it yourself, you just make sure you ask your IFA or your fund manager, mate, what's in the portfolio? And why the hell has it got these things? Right, I don't want that fund. And start looking elsewhere, which I'll come to how you might find it. And by the way, that's what's then left. You end up out of 10,000, about 150 listed. I keep saying listed for this reason. It means you can get the hell out by the click of a button. Because that's how you get out of a Microsoft or whatever. This was last year's performance. I'll put it on my LinkedIn, so don't worry if you can't see it. I'll tell you what I like at the moment, which isn't advice, but I'll tell you what I like in a moment. The idea is does the standalone work? I'm going to go over there. The idea is, what you're then left with is a whole bunch of companies which should generate more. I can't guarantee which one. If I knew which one was going to get 300%, I would have put all my money in there. I would have auctioned my mother-in-law on eBay, taken the proceeds, not that I would have got much, and put it into that 300% return company. But once I narrowed it down, I was able to say, from this gene pool of companies, we should have a strong return. And with a tailwind, a good positive market return, even better. I'll take credit for the tailwind all day long. I'll take credit for the geniuses working at Crocs. Thank you very much, Crocs. I didn't think they were going to get me 200%. And then the numbers that get you a negative return, oh yes, there are loss-making companies. Nobody has a crystal ball or a time machine. That should be restricted. Hopefully you can all hear me. Now you might say, well, wait a minute, Alpesh, you're talking about stocks. Look, you're already invested in the stock market if you've got a pension, because where the heck do you think that money goes? The number of people who get shocked thinking the tooth fairy delivers them a pension return, it's not. It's overpaid, useless fund managers, and I've never met a good one, okay? Trust me, I went to university with some of them. They're the ones taking out the fee. So I want you to at least have the knowledge. That's all I'm saying. I'm not saying go out and speculate without knowing what you're doing, but at least have the knowledge to know where your pension money's been going. And you might say, well, I'm worried. I don't want to do it at an all-time high. Well, what that shows you is actually even at all-time highs, you still get a positive return. And if there is a market downturn, and personally I hope there is a bit, because the returns get even better. And that data is provided by a Nobel Prize-winning economist, a chap called Eugene Fama. Can take a picture, but as I said, I'll make sure I put it on my LinkedIn page as well. These are the numbers I want you to be aware of. There are 7 elements in the strategy that you should be looking at when you're looking to invest in any company, whether it's your own or anybody else's, in particular a listed company. I think you should hold for 12 months and then reevaluate, because the world moves too quickly to hold buy and forever. I think you should have about 15 to 20 stocks, roughly. I can show you the data on that offline if you wish. If any drops 25% from the peak they've been, you'd want to get out. I target 40% returns. If there's a fair wind, I do more. If there isn't, I do less. Forget that. Look for at least 15 to 20% returns. Okay? So how are we going to do that? Where's that coming from? That's a slide. You can't see it properly on there. That's a slide from Goldman Sachs which shows why 12 months is better. We won't go and bore you into the technicalities. Now, this bit's going to put you off, but don't be. The complexity of it is, yes, you need to know 7 different things. The value of a company. Okay, you need to know the value. You need to know revenue growth of a company. You need to know why PowerPoint isn't moving forward. That's critically important. Okay, it'll come up in a minute. Value, revenue growth, cash flow. Now, I don't care which metrics you use. I have mine. You might have yours. Places like Yahoo Finance, Google Finance will allow you to even screen for this free. But look at least those 3 things to start off with. Why? Because you know those things are bloody important. Profitability, the valuation of a company, the share price compared to profitability. Cash flow growth, probably the most important. And if you don't believe me, cash flow is probably the most important. Please leave. You're in the wrong arena. You meant to go to the maternity thing over there. Seriously, if you don't know why cash flow is important, same for public companies, cash flow. Now I have a measure of cash flow. I won't go into the boring details what it is, but cash flow and sales growth, okay? That's a boring technical chart. Why cash flow is important? I stole this. I stole it from Goldman Sachs Asset Management because I figured if you haven't got $50 million to give them your money and them charge you and do it for you, then you can just steal it on what they do. And they look at that. They look at cash return on capital invested. Now to you guys, that jargon will make sense. It makes sense to me. You don't need to learn the formula. But what I'm saying is if you want to know the most important thing, please focus on cash flow, valuation, revenue growth. Then you can narrow those companies down. Now you might say, nah, forget it, I'm rich, I don't need to do any of this, I've got somebody to do it for me. My whole point is the people doing it for you are underperforming. They're not vested like you. 15 stocks, 12 months, then review, start again. Look in a gene pool of 10,000, not just UK. And we are not going to speculate on which sector, which geography. Trust me, neither you nor I are clever enough to see into the future. What you're going to do is valuation, growth, cash flow. I don't care if they make ugly shoes or if they make iPods. Valuation, growth, cash flow. Okay, those are the things. And let's look at some numbers. Let's say you did 20% per annum, and you might think, no, don't be stupid. Well, just look at the all-time highs we've just had. Say you did 20% per annum over the long term. And by the way, that formula from Goldman Sachs, that generates 30% per annum over the long term. Some years more, some years. That's why they're rich. 30% per annum. If you want to know why the rich get rich, that's from Goldman Sachs Wealth Management. And I stole it when, being in the hedge fund industry, they send you this kind of stuff because they want you to be their client. Well, I'm not stupid. So I saved a lot of money, and I'm sharing it with you. 30%. You knew they had a secret, didn't you? And you thought it was insider trading. Well, it is that as well. Go ahead, sue me, Goldman's. All right? It's that. It's the cash flow thing. 30% per annum. Don't take my word for it. It's their figures. And we looked at it, and we did it. And it is. And it's true. And now you don't need $50 million to be their client. So let's look at the numbers. Let's say you put $500 in a month into your pension. Whoever your provider is, I don't really mind. They all charge whatever they charge. And you start with just 10K. This is how your pension moves. Now, my son's ISA pretty much looks like that. And he's about 3.5. And you know when people go, oh, it's power of compounding. Do you know why nobody does it? Because the power of compounding hits in after about 10 bloody years. So for the first 10 years, don't go out, don't go to cinema, don't go to restaurants, just rely on the power of compounding and sit at home and bore yourself to death. No. The fact of the matter is, yeah, it does work later on. It is worth it, even if you're starting off with an ISA and putting 3K in. So my spoilt little 3.5-year-old son, maximizing his returns, and I kid you not, he does now when I'm trying to watch football, come in on an evening and say, Daddy, where's the stock market? I know, I'm a bad parent. And that's the future, behold. But by the time he's going to university, he should have about $500,000, the spoilt little brat. Obviously, I'll raid it before then and make sure he doesn't get to keep it all. The point is, small sums, small contributions. Your fund manager isn't doing that. You've got to do it. If you're waiting for some secret reveal where I say, go to this website or go buy this fund, it's not coming. I'm going to just show you how you do it yourself for free. And if you've got a bit more money, because you're like Donald Trump and seriously rich, and let's say you've got 100K or $1 million, work it out, and you put 1.5K in, well, after 10 years, that's what happens. You start with 100K, that gets to 10 million. Sorry, that gets to $1 million. So your job becomes convert every 100K into $1 million, or every 10 into 100, then 100. And if you've got a business, you need to be doing that as well. That's your side hustle. Why? Because if at any moment you wake up at 3 in the morning and say, screw this, I don't want to do this, you can click a button. You can't do that when you've got a factory, when you've got employees, when you've got fixed costs. And I don't want you just relying on a bloody fund manager looking after your future, because they will look after their own and their children's school fees and charge you for it, and you will be none the wiser that they've done that. How do we know? Because of the numbers I've shown you. And this is what happens. Okay, so that's where we want you to try and get to yourself. So I want you to look at valuation, revenue growth, and cash flow for those public companies. Where's the data? Yahoo Finance has it, Google Finance has it, it's out there. All right? It's in a lot of places. Now, I will leave you with because you probably want to know, well, what do you like? This is not advice because I don't know your personal circumstances, but you'll occasionally see breathless headlines like Goldman says, buy these 20 stocks that have the most potential. So we looked at it. We looked at their names, which they said, and then we looked at which ones meet our metrics. I don't care if they like it. I want to know, does it meet my valuation metric? Does it meet my metric for revenue growth? Does it meet my metric? Because my metrics are a hell of a lot stricter than theirs. You know why? Because whichever companies I have to invest in, whether it's, like I said, whether it's, I don't know, PayPal or a Adobe or a Microsoft or an NVIDIA, so I've put on the left which ones I happen to own, well, they're looking after my retirement money. That's what those companies are doing, obviously, because I've invested in them. Or they're looking after my son's future. So they better be bloody good. So I better filter down from 10,000. There is no fund manager on earth who gives a damn about my retirement as much as I do, or my son's future as much as I do. They do give a damn about charging me 10% every 5 years, though. They won't miss that invoice, right? So I want you, many of you are young, some of you are retirees. I just want you to get richer, basically, and not giving all your money away to overpriced fund managers. I don't hold the ones in the middle, but they were in my list because I can't buy everything, okay? And there are some which Goldman's like, which I don't. But for you to have that same level of confidence, you need to know you're going to look at three things: value, revenue growth, cash flow. And that kind of stuff you can learn off the internet, but Google Finance, Yahoo Finance will have that kind of stuff. 12 months, 15 to 20 stocks. Don't buy hundreds because you think, oh, I'll put a bit in everything. We're not in the spray and pray business because we need to get a return, okay? We'll also look at what do other funds who are getting more than the 40% we want, because we're humble enough to know we don't know bloody everything. So we'll look at any hedge funds out there which are getting more than 40%. What do they own? And this happens to be one. Well, I don't own everything they own. I do happen to own some of the stuff that they own. So we will steal, happily steal. I might be the only speaker today openly saying how much I'm going to steal from the rich and give to the regular people, sort of a Robin Hood, I hope. Volatility, I'll put that on LinkedIn. It's just, what's the downside risk? Some stock, what's the chances, Alpesh? I'm risk averse, Alpesh. What's the chances that stock could drop 20% in the next 6 months or 12 months? They're listed companies. Yes, you can click a button and get out, but what if they drop? Well, it's going to, same thing's going to happen with a fund manager. So what's the volatility? Again, all this data I'm showing you was free from the internet. Have a look at that. It's completely free. It's my campaign to teach 1 million people how to invest for free. You can download a free copy of my book from there and a lot of free other materials, including a Telegram channel, which each day I post free stuff to educate people how to do it, okay, and how to be better at it. I want British retirees, British self-employed people, because I'm in that category, to do a lot better, and I want British fund managers to do a lot less well in the fees they charge you guys, because it's trillions you've given them, and it's a percentage of that trillions which is making them rich. Where are your, like I said, where are your yachts and private jets? So please take the time to learn a bit more about your SIP, your ISA, how you invest, and when people try and shove funds down your throat, say, no, I don't want funds, I want to pick myself which ones I might like. And like I said, now more than ever, that data's available. So all that hard work you're doing in building your businesses and seeing all these other companies here today who are helping you grow your businesses, that effort won't just be concentrated in your own business or your own profession, but you'll hopefully have a SIP or an ISA which will be generating as much, if not more money. So God forbid anything happens in your business, you're diversified. And Apple's got your back, or Amazon's got your back, or Visa's got your back, or whatever else you've also invested in. Good luck with it all. Campaignfor1million.com. It's a completely free site. It's got all that free information on there. I hope you found that useful. And I hope to, see you at a future event. Thank you all very much. Thank you.